Looking at the Markets with David Modell. Welcome to Looking at the Markets with David Modell. Today I've got a special guest. He is hailing from Queenstown, New Zealand, and he is Mr. Callum Thomas. He is the head of research at Top Down Charts, topdowncharts.com. I have a feeling that Mr. Thomas doesn't just like charts, he loves them, because he is one of the chart masters. I put him up there with guys like Mr. Chris Kimball, Mr. Dana Lyons, and I've interviewed those guys, and I would put him in an elite class of chartists. He likes charts, data, macro, multi-asset investing, economics, geopolitics, and he even is a bit of a contrarian in his own way, and I'd like to tap into his wisdom today. First of all, Mr. Thomas, thank you for joining me today.
Yeah, thanks. It's very excited to do this.
Absolutely. And first of all, Top Down Charts. Wanted to talk about that. If people go to topdowncharts.com, what will they see, and what are the services that are being offered currently?
Yep, sure. So I'll probably give a little bit of background on the company first. So
Sure.
it's I started it up just over 6 months ago now, and it was partly a desire by me to actually start a business. I just kind of wanted to do that. I kind of felt that it was something that I had to do. And so I left my job at a big fund manager. I was working in the multi-asset research team there. And we're doing a lot of interesting things there. From your sort of bread and butter pension funds, where you're doing asset allocation and dynamically adjusting the asset allocation to a couple of funds where it's more a little bit more discretionary, long only, go anywhere kind of macro funds. So that's probably good insight into where I've spent sort of most of my career in that kind of space, looking globally across the world, trying to find the best opportunities. And that's what I'm doing here with Top Down Charts. It's very much chart focused research, very data driven, chart driven, and pretty much trying to look across the world, global markets, across asset classes to find the biggest risks as well as the best opportunities for investors who also share that kind of philosophy of looking across asset classes. And probably the biggest customer base of the professional services that I provide, so that's the weekly macro themes report. The biggest customer of that is fund managers themselves. So people that I kind of like, the people that I used to work with, kind of thing. Multi-asset portfolio managers. But I think it's also something that can lend itself to investors that do sort of take that kind of approach. And in terms of the website itself, I also put some blogs up there. So it's certainly a resource for the average punter as well. And there's a post on there that I also put onto See It Markets, which I think we're going to talk about later as well. So I guess that's probably about it, unless you had any other questions that you wanted me to look at on that.
No, that's great, and I would recommend that everybody check out topdowncharts.com, as well as Mr. Thomas's tweets, both on stocktwits.com as well as Twitter. And speaking of those tweets, I'm telling you, when Callum Thomas starts his chart storms, get out of the way. I don't even tweet when you're doing that, because I know that there's going to be a flood of amazing charts, and any charts that I try to post, no, I won't even bother with it. I wait till you're done. So what is a chart storm?
Yeah, that's a very good question. It's something that I came up with probably a couple of years ago now, and it's pretty much just a whole bunch of charts on a single topic. My traditional chart storm is the S&P 500 chart storm, which I do I guess it's Sunday morning my time, which is, I think, middle of the afternoon on Saturday, you guys' time. And, basically just go and try and find some of the best charts that have crossed my path over the week, and anything that I've managed to come up with as well. And there's a lot of different you build up a lot of sources over time, and I try to bring in as many different perspectives in it as possible. So touching on anything from technicals, very short term, timing indicators, through to some of the longer term things. Age of the average age of the company in the S&P 500, things like this. And I think that has had a pretty good reception of that. And I think that's probably been a key reason why I've managed to build up my followers on Twitter. And I appreciate people following me, and always very dedicated to getting those chart storms out. Whenever I'm off on holidays, I make sure I get down to find a coffee shop with a Wi-Fi so that I can still still get it out. So and I think that reflects my love of charts, as you mentioned at the start. I think that they are brilliant means for not only displaying the trends, communicating the data, getting the insight across, but also for telling stories as well.
I like that, telling stories with charts. And you mentioned being data driven. That is so important to me. Keeps the emotions out of it. And your chart storms are so much fun to watch and learn from, with over 35,000 StockTwits followers and over 15,000 Twitter followers. I think you're doing something right with those chart storms. So we'll be looking for that for sure. And also, can we see a lot of those charts as well as that information at Top Down Charts?
Yeah, well, you're probably actually the best place to go to see the chart storms is on Twitter itself. I've started experimenting with doing a bit of a YouTube video following the chart storm, just as a bit of a way to get a few extra thoughts out there, and a little bit of extra context beyond the 140 characters.
Yeah, understandable. So I'll be looking for that as well. Speaking of those excellent charts, I'm looking at one of your chart storms right now, and one of them says seasonality. Bulls will say don't worry, but bears will be saying time is running out. And I'm looking at the chart right now, and it's I don't know, kind of scary, but I like the way the chart tells two sides of the story. What is your perspective on the rest of 2017 in terms of the S&P?
Yeah, that's a good question. I mean, on seasonality alone, picking up on that comment, I mean, there's a couple of perspectives that you can take on that, right? In the short term, there is a little bit of positive seasonality left, but then we get into this period where, from sort of about May, June onwards, the old expression "sell in May," you tend to get more volatility through that period. You tend to get more market headwinds through that period, and I think this market just feels completely overdue for a good old decent correction. Expectations have been bid up pretty high. Valuations are towards the top end of the range, depending on which indicators you look at. And even on the sort of shorter term charts, you can see that the market does look a little bit tired. I'm actually reasonably bullish on the US economy, the whole market as a whole, sort of over the medium term, especially given what's going on in the global economy, and what's going on the earnings front. We've had a decent turnaround from that sort of earnings recession that we saw last year. So I would say, I still, we could definitely end the year higher, but it kind of feels like we have to go for a little bit of a test before we can make it through to that point.
Absolutely. Wanted to talk about another scary thing, to me at least, besides the coming seasonality changes: margin debt. Is it getting too high? Is this sustainable? What does it mean for the economy?
Yeah, so I guess probably most people have seen the chart of margin debt, and how it's gone to an all-time record high in February. I saw a lot of those charts getting bashed about. I even included a couple of them in a recent chart storm. And so, to me, when you come across a piece of data, you've got to explore it. You've got to take it apart. You've got to, mess with it a bit to really get the true signal out of it. And so when we're talking about the absolute level in nominal terms, oftentimes for something like the level of debt, it can be actually pretty meaningless. So there's not really that much information in that at all. So what you really need to do, the first step is to look at it against market cap, and there's quite a few charts of that around as well. But you compare it to market cap, and it's elevated versus history, but there's not really anything in there that looks sort of interesting, or there's not really. You look at the chart, you don't really see any signal. For me, when you look at the chart, the signal should be clear, and I'm not actually that big on the whole econometric analysis where you use advanced statistical techniques to determine causality, because if the relationship's not clear by looking at the chart, then no amount of statistical analysis is going to make it pop out. And so what I decided to do for margin debt was look at the rate of change. So that's one way of sort of messing with it, or transforming it to try and get a signal. And the rate of change, the year-on-year rate of change of margin debt, actually provides a pretty good signal. The peak of the 2000 dot-com boom, and just prior to the financial crisis, you actually had a massive spike in the year-on-year growth. I call that acceleration. And when you have too much acceleration, what that reflects is people sort of rushing in, making a mad rush to get into the market. It's that whole FOMO, fear of missing out, and that's one sign. And when you see that, you'd probably start to have a pretty serious think about what's going on, and have a pretty good look at a lot of other indicators, whether the economics are rolling over, whether valuation's high, and that's the kind of thing that would provide a sort of multi-factor setup for getting very bearish on the market. And then a sort of confirming indicator, or the second kind of signal that you get from it, is when it goes into negative territory. So the moment you see margin debt contracting on a year-on-year basis, and what what that's going to be reflecting is not only people saying the fundamentals are deteriorating in these individual stocks that I'm watching, and therefore I'm going to close out these margin leverage trades because I'm losing conviction on them, but also people actually starting to be forced out of their positions as the market actually starts to roll over, and that's where high levels of margin debt come home to roost. It's when things actually start. Well, things have already started to get bad. So those are the signals that I'm looking for, and at the moment it's not really giving you anything on either of those fronts. It's positive, and it's not really accelerating to the point where it represents a frenzy, and when it's in this kind of range, it's actually kind of really a green light. So in that respect, if you're losing sleep over the level of margin debt, I would say watch this signal, and for now you can you can go back to sleep.
Sounds good to me. I love to sleep, so but I'm not going to sleep on these signals that you're sending out, because they're very, very important. You were kind enough to send me your weekly report. Is this something that anybody can have access to? Who can get your weekly report?
So that's the premium service. So it's mostly aimed at fund managers, institutional investors. But I do offer free trials. So if you want to have a free look, you can jump onto the website, fill out the form there, and request either a copy or a trial. And if you like it, and if you think you want to keep on receiving it, then we'll get in touch.
Absolutely, and I will be putting topdowncharts.com contact information in the description for the video. Just wanted to talk real quickly, if you don't mind, about inflation, expectations versus reality. You mentioned in your weekly report that the pause in inflation expectations that we're experiencing right now could reflect rising doubts about the return of inflation, but you're not counting on that just yet. Could you expand on that?
Yeah, so I guess one chart that people have been looking at quite closely is that of inflation expectations, so market-based measures, and you know, it had reached multi-year lows sort of around the middle of last year, and that was the time when everyone was pretty focused on deflation. The narrative had switched to this whole idea that there's a lot of structural forces that are going to bring about a sort of persistent period of deflation, or all these deflationary forces, and then all of a sudden, as the global economy narrowly averted recession, and there's a number of reasons for that, we saw this big synchronized global economic upturn, and it was reflected first in the PMIs, and we're actually starting to see it in the hard data now as well. So, I guess that's the first clue of my opinion on this, is that the initial wave of the pop higher in bond yields, the pop higher in inflation expectations, that was driven by a lot of improving survey data and improving markets. But we are actually starting to see hard data come in to confirm that. And so the other thing is commodity prices. The rebound in that also played its role. But you look at it across the developed economies. US unemployment rate is down, almost back to pre-crisis levels, and it's the same story across developed economies. You look at Japan, you look at Europe, and I've got a composite chart here. I might put that up on Twitter so that people can see it. And so that shows the composite unemployment rate, and that's very, very close to the levels that it got to, just prior to the crisis. And the lower the unemployment rate, the more ultimately inflationary pressures you're going to get as a result of that. It represents a tightening labour market. And by the same token, you look at capacity utilisation, and that's towards the upper end of the range, not quite the same levels as prior to the crisis. And so, for me, if you want to see more than a temporary burst of inflation, you have to see a tightening of capacity, and it's taken quite a while for that capacity to get used up. As that trend continues, we're going to see a more fundamental drive towards more inflation, rather than just being driven by sort of a rebound in commodities. And that's probably something that investors need to keep an eye on. I'm not predicting some sort of hyperinflationary wave to come through, but a return to inflation is definitely something that you want to have as your base case, and that's going to have I guess the most immediate impact that it'll have is that the Fed is just going to carry on hiking interest rates in that environment.
And finally, because I know you're a busy man and the market is still open, what are you bullish on right now? Let's get to the bottom line. Do you like equities right now? Gold, silver, oil? What are we looking at?
Oh, that's a good question. I would say I'd be selectively bullish on equities. So, I mean, as I said, the US market looks like it kind of needs a little bit of a reset, but, you look offshore, Europe, I think, still has a lot of potential. There's still, there's definitely a relative valuation case there. And, you look at the economic indicators in Europe, things are actually pretty good right now. And, if you just look only at the manufacturing PMIs, Europe's actually blasted out ahead of America. So, somehow Europe's managed to become great again, but there's still a lot of political risk that's sort of holding things back there. And I think if you get something there that just takes that political risk off the table, there's no telling how fast markets are going to reprice. And I think the French elections, where obviously there's a risk there. There's definitely risk there, and you can't count it out. But if you have that pass with no sort of bad outcome, Le Pen or whoever, I think that could be a bit of a catalyst to drive a reassessment of risk in Europe. And so, that's probably one region that I'd be looking at. But, on the US front, I'd still sort of be cautious in the immediate term, looking for anything in the charts that would change my mind on that.
And we're always coming back to the charts because that's so important at topdowncharts.com. If people want to contact you for more insight, or perhaps to sign up for a free trial of the newsletter, or just to check you out, see what Top Down Charts is all about, how can they contact you?
Yeah, just through the website. There's a contact form on there, and if they wanted to trial the weekly report, you just click onto the subscribe tab and click through to the macro report and fill out the form. It's pretty much as simple as that.
As well as StockTwits and Twitter, people should be checking out Callum Thomas, Callum, and then there's an underscore, I believe they call it, an underline, and then Thomas. That's on Twitter, and I believe on StockTwits, same thing, Callum underscore Thomas. Am I right?
That's right.
Very good, sir. I know you're a busy man, as we all are, but I am so privileged to have spent this time with you. Mr. Callum Thomas, thank you so much for joining me today. I really appreciate it.
Oh, great. It was a pleasure.
Absolutely.